$638 billion. That's how much revenue one company already has locked in from customers who are legally required to pay it, and the stock is still sitting more than 50% below its high. If that sounds like a contradiction, that's because it is. And by the end of this video, you're going to understand exactly why Wall Street is looking at a receipt this big and still walking away confused. I'm going to walk you through 5 stocks that are all over the headlines right now, and for each one I'm going to tell you straight, buy it or stay away from it, and exactly why, with real numbers, not vague hand-waving. If this is the kind of breakdown you want every week, go ahead and subscribe to Tickerhawk now so you don't miss the next one, because some of these calls are going to move fast. Let's start with the name that's dragging the most attention right now, and it's Oracle, ticker ORCL. A year ago, Oracle's contracted backlog, meaning money customers have already committed to pay under signed deals, sat around $138 billion. Today, that number is $638 billion. That's more than a 4x increase in 12 months. And for context, that figure is roughly what Nvidia's entire market cap was back in 2021, when it was already one of the hottest stocks on the planet. Except this isn't Oracle's valuation. This is just the paper trail of contracts sitting on their desk. And here's where it gets interesting. Nearly half of that backlog traces back to a single deal, a $300 billion 5-year agreement to supply computing power to OpenAI. That's roughly $60 billion a year from one customer, which is close to the size of Oracle's entire existing business today. When that deal was first announced, Oracle's stock jumped so hard in a single day that it added almost $250 billion in value, the biggest one-day pop the company has seen since 1992. But here's my honest take. I'm telling you to stay away from Oracle right now. And I know that's going to surprise some of you given how big that number sounds. Here's why. To actually deliver on all that computing power, Oracle has to build the data centers first, and building is brutally expensive. Their construction spending went from around $6 billion a quarter 2 years ago to roughly $16 billion a quarter today, north of $55 billion a year. That spending flipped their free cash flow from positive territory to roughly negative $24 billion. That's a $60 billion swing in the wrong direction in just 2 years. So yes, the backlog is real, but so is the fact that Oracle is borrowing heavily to build for a customer, OpenAI, that doesn't turn a profit and hasn't gone public. If OpenAI stumbles even slightly on that payment schedule, Oracle's whole growth story gets a lot shakier, and a stock trading on future promises with negative cash flow today is not where I want your money parked right now. I'd rather watch this one from the sidelines until that cash flow trend actually turns. And I'll tell you the second it does. Drop in the comments if you're holding Oracle right now, because I want to hear the other side of this one. And look, I get why people don't want to hear a void on a stock with the biggest backlog in the company's history. It feels wrong on the surface. But think about what a backlog actually is. It's a promise, not cash in the bank. Oracle still has to spend billions building the physical data centers before it collects a dime of that. $638 billion. And right now, every quarter that goes by adds more debt to the balance sheet before the revenue ever shows up. That's the trap. A number that big makes the stock look like a screaming bargain, and technically the multiple on paper does look cheap relative to that backlog, but cheap on a promise is not the same thing as cheap on cash flow that's already in hand. I want to see at least 2, maybe 3 quarters of that construction spending starting to level off before I even think about stepping in, because that's the point where the story flips from we're spending to build something to we're finally collecting on what we built. Until then, this is a watch list name for me, not a buy list name, no matter how loud that backlog number sounds. Now, let's flip the script completely, because the next name is one I actually like, and it's a lot smaller and a lot less talked about. It's InnoData, ticker INOD. Think about the AI race for a second. Every lab out there, whether it's OpenAI, Google, or anyone else, needs massive amounts of clean, human-checked data to train their models. It doesn't matter who wins that race, they all need the same shovels, and InnoData is one of the main shovel sellers. Here's what changed the game for them. Their biggest competitor, Scale AI, sold roughly half of itself to Meta for around $14 billion. To put that in perspective, Meta spent about 7 times InnoData's entire market value just to buy half of one rival. But the second Meta owned a piece of Scale AI. Other big labs like Google and OpenAI started pulling their work away from Scale because nobody wants to hand their secret training data to a company that's half owned by a competitor. That turned InnoData's independence, which used to be a footnote, into its single biggest advantage overnight, and the growth numbers back it up. Revenue grew 58% last quarter, the 12th straight quarter of growth, with management guiding for at least 40% for the full year. A year ago, one customer made up more than half of InnoData's total revenue. Today, that same customer is down to about a third, not because it shrank, but because everyone else around it grew. A second major tech company went from almost nothing to nearly a third of revenue in a single year. My call here is buy, but size it small. This is a $2 billion company trading at around 46 times earnings. So the growth is already priced in, and short interest sits near 14% and climbing, meaning plenty of traders are betting against it. Insiders, including the founder and CEO, have also been selling stock into recent strength, which is a fair yellow flag. But none of that changes the underlying machine. The very thing the shorts are leaning on, customer concentration, is the exact problem Innodata has been fixing all year. I own a small position here and I'm comfortable adding on weakness, but this is not a stock you back the truck up on. Treat it like the volatile, high upside name that it is. Before we move to the next one, quick gut check for you. Which of these 5 would you actually put new money into today? Tell me in the comments, because I'm curious if you're seeing this the same way I am. Because the next stock might be the one I'd put money into before either of the first 2. That's Sterling Infrastructure, ticker STRL, and this one is about as clean a buy case as you're going to find on this list. When a tech giant decides to build a data center, long before a single server ever powers on, somebody has to grade the land flat, pour the foundation, and wire in the power. That unglamorous groundwork is Sterling's whole business. They don't own the data centers. They build the ground underneath them. Their backlog, meaning work they're already contracted to do but haven't finished, now sits north of $5.5 billion, up 50% in a single year. That's more signed work than the company completed in the previous 2 years combined. Revenue nearly doubled last quarter. This company carries no net debt and posts a return on equity around 40%, numbers that are almost unheard of for a construction business. And despite all that, the stock is trading about 46% below its high. Here's why. Last year, Sterling bought an electrical contractor so it could bundle groundwork and wiring into the same job. That electrical work runs at a thinner margin than Sterling's core business, so when you blend everything together, the segment's operating margin slipped about 4 points. Wall Street saw that dip and sold the stock hard, treating it like the business was losing its edge. But management was upfront that it's purely a mix issue, a slightly less profitable business bolted onto a highly profitable one, pulling the average down a bit. My verdict is buy, and I hold this one with more conviction than almost anything else on this list, even though it's not statistically cheap at around 40 times earnings. Growth is expected to cool from around 60% this year to the low 20s next year, and that's a legitimate reason to want a better entry price. But the acquisition that got Sterling punished is the same one that lets them win bigger, more complete contracts going forward. The market sold this stock because one margin number ticked down. In the same quarter, its backlog grew by half. That mismatch is exactly the kind of opportunity I look for. Sterling builds the ground the data center sits on. The next company builds the power that feeds it, and this is where I want you to pay close attention because the story here is genuinely different from the last 2. It's Mastech, ticker MTZ. For about 20 years, America's electricity demand barely moved, a flat line going nowhere. Then AI data centers showed up, and now the power those centers pull off the grid is projected to roughly triple by the end of this decade. Somebody has to string the new transmission lines, build the substations, and wire all of it into the grid, and Mastech is one of the companies doing exactly that. Their backlog, the signed and contracted work waiting to be done, sits north of $21 billion, an all-time record for the company, up 30% in a year. Last quarter, the company beat expectations and raised guidance with their power delivery and clean energy divisions, both firing on all cylinders. So why is a stock with a record backlog down nearly 40% from its high? One of Mastech's smaller divisions, the one that builds cell towers and telecom infrastructure, hit a rough patch when a couple of major carriers slowed their spending. That weak corner spooked the whole market, and the stock got hammered in a single session, even though the power business, the part that actually matters for the AI story, was hitting record highs at the very same time. Here's my honest read, and it's a wait, not a buy, at least not yet. Unlike Sterling, Mastech carries real debt, and a large chunk of that record backlog is scheduled to convert into revenue next year, not this one. Their strongest cash flow doesn't even show up until the back half of this year. The chart is broken, momentum is against it, and there's less room for error given the debt load. I love the long-term story. The grid has to be rebuilt, and Mastech is one of the few companies positioned to do it, but I'm not chasing a falling knife with real leverage attached to it. I'm watching for the cash flow to actually show up before I put new money in, and when it does, I'll be one of the first to tell you. If any of these calls are hitting home for you, go ahead and share this with somebody who's been asking you what to do with their portfolio right now. It genuinely helps the channel, and it might save them from a bad decision. Now, for the one that's honestly the highest quality, business on this entire list, and also the strangest story, and that's AppLovin, ticker APP. Every other stock we've covered today is a builder, pouring money in now and waiting years to get paid back. AppLovin is the opposite. It runs the software that decides which ad you see inside mobile apps and increasingly inside online stores, powered by an AI engine that keeps getting more accurate. The economics here are almost absurd. For every dollar of revenue, close to 80 cents falls straight through as operating profit. For comparison, Visa, a company everybody considers a money printing machine, runs an operating margin in the mid-60s, and AppLovin is running higher than that. Despite those numbers, the stock is down more than 50% from its high. Revenue grew almost 53% last quarter, and the company generates so much cash, it's been buying back its own stock. After that drop, you're paying around 21 times next year's earnings for one of the most profitable software companies in existence, a multiple this stock almost never traded, and even when it was a market favorite. So why did it fall? For over a year, AppLovin was under a cloud with short sellers publishing reports questioning its ad targeting data practices, which eventually led the SEC to open a formal investigation. That fear followed the stock the entire way up and the entire way down. Then, on the same day the company reported earnings, they announced the SEC had closed the investigation with no action taken and no wrongdoing found. The single biggest risk to the entire business was wiped off the table. And the stock still dropped about 20% that day, because in the same report, growth guidance came in slightly below expectations. The company's first guidance miss since going public. My call is a clear buy. Yes, the growth is cooling a bit. Next quarter's guidance points to around 47%, which is still enormous. And yes, a chunk of future growth depends on a newer e-commerce ads business that only opened up broadly this summer and hasn't proven itself at scale yet. Those are fair questions, but think about what actually happened that day. The company got the best possible legal news of the year, and the market only reacted to one soft number. The scariest thing that could have happened to this business, a regulator ruling it broke the law, got permanently taken off the table, and the stock still got punished for a minor guidance miss. That's a market overreacting to noise while ignoring the signal. I already hold a position here, and I'm adding more as the chart shows signs of stabilizing, because fundamentally, this is close to an impeccable business trading, like a broken one. And here's the part that really gets me about this whole setup. Stocks usually get cheap for one of two reasons. Either the business is actually breaking, or the market is scared of something that hasn't happened yet. AppLovin's case was the second one, fear of a regulatory hammer that never came down. Now that fear is gone, permanently, and the stock still hasn't repriced back up to reflect that. That gap between what the risk actually is today and what the stock price still assumes it is, that's usually where the best setups live. I'm not saying it can't drift lower in the short term. Momentum stocks do that all the time on their way to a bottom. But the longer this mispricing sits here unresolved, the more attractive this name gets to me every single week. So here's where that leaves us. Stay away from Oracle until that negative cash flow trend actually turns around. Buy Innodata in small, controlled pieces given the volatility. Buy Sterling Infrastructure with real conviction. It's the cleanest setup on this list. Wait on Mastech until the debt picture and cash flow improve, even though the long-term story is strong. And buy AppLovin, because the market is pricing in fear that's already been proven wrong. Markets like this don't stay confused forever, and when the mood flips back, it tends to flip fast, which means the window on some of these names might not stay open much longer. I'm already tracking 2 more names that are showing the exact same pattern, contracts and cash flow that don't match the stock price, and I'll be breaking those down next. If you don't want to miss that one, make sure you're subscribed to Ticker Hawk and drop your own pick from today's list in the comments, buy or avoid. I read every one of them.